Good morning, you're watching Business World Live. I'm Danie Laurel. It's the start of a new trading week, but first let's go straight to our top story. Economic contraction likely eased by 8.5%. That's in the fourth quarter. That's on the back of higher consumer spending during the holidays and as the government eases quarantine restrictions. The quarterly forecast from Business World economists is less severe than the 11.5% slump in the third quarter of 2020 and the 16.9% contraction in the second quarter, which placed the country on a technical recession. If realized, this would bring full-year GDP contraction to 9.5%, the first decline since 1998 and the steepest one in at least 7 decades. The full-year estimate falls within the higher end of the government's 2020 GDP target range. The central bank, meanwhile, is expected to keep rates steady. That's at a record low of 2%, according to Standard Chartered Bank. This is to allow substantial credit growth and make way for monetary easing to pass through the economy. Bank lending has yet to pick up despite the boost in liquidity as business sentiment remains subdued. The multinational lender sees Philippine GDP shrinking by 8.9% in 2020. That's higher than Business World economists' consensus, but still within the government's expectations. The fourth quarter GDP data is set for release this Thursday. That's January 28th. Okay, guys, checking in on global equities as we start trading this Monday morning. Now, over in the United States, investors are looking ahead to the Fed meeting this week and more earnings. That is, of course, after Wall Street closed lower on Friday. You can see on my terminal here how that happened, save for the NASDAQ, which was actually enjoying a bit of a bump up. You can see the benchmark S&P 500 down by 0.3%. The Dow Jones down by 0.6%. Now, which companies are reporting this week? You've got Microsoft, Apple, Tesla, Facebook, and Samsung. So that's probably also why investors are very much looking at the NASDAQ. Now, let's take a quick peek at Asia Pacific here. Asia stocks are seeing quite a muted start to trading this week as well, but you can see Japan opening in the green, the Nikkei 225 up by 0.4%. The S&P actually in Australia, you did see a bit of a positive open as well this morning, and in Singapore. So a bit of some sentiment, better at least than how Wall Street performed on Friday. This amid more concern that this new coronavirus strain may actually be deadlier than the earlier new variants that we've been seeing. There's also growing frustration in terms of vaccine distribution. So this, according to a Facebook post from Italian Prime Minister Giuseppe Conte, delays in consignments by Pfizer and even AstraZeneca, he called them unacceptable. You've also got over in the UK, the health minister warning that the vaccines may be less effective against the new variants of the coronavirus. This seems to have dragged the stocks down, at least last week, from all-time highs. So to take a quick peek at how our own local index is performing, a lot of eyes are on that GDP print precisely, and you can see that at the open we are continuing that decline from last week, opening down by 0.3%. Now recall, last week we already saw a week-on-week decline of 2.7%. So we were still closing in those 7,000 levels, a dangerous support level to be breaking lower on. This, however, comes amid heavier trades. So at least last week we had a turnover of higher by 21%. So basically 12.7 billion per day of trades, which is much higher than the normal daily average, albeit average net foreign selling expanding to close to 1 billion pesos per day that we've lost to our foreign buyers, at least from last week. Now, this, according to 2Trade Asia, they say that while negative figures may have already priced in when it comes to GDP, and that is already expected, any sort of downside surprise will be detrimental. He says it's already directionless in terms of where we are going. So anything that is worse than expected will be really bad, particularly for cyclicals and anything that is recovery correlated. And Phil Stocks, meanwhile, is watching out for that spread of the new strain or variant in the country. Recall that now we've got 17 cases of this more contagious virus variant, so to speak. Now, of these new cases, we've got 3 patients recovered, 13 active, 3 asymptomatic, and 10 with mild symptoms. But one thing to be optimistic about, at least this morning, even as the index is sliding, is the fact that you've got more projects, at least infrastructure projects, coming into the foray. You've got the opening of the new Clark International Terminal at hand. That was, of course, by Megawide, and they have now turned that over to the government. So this is the Megawide GMR Consortium, and they've turned that over to the government, and LIPAD, which is the Luzon International Premier Airport Development, which is, of course, formed by JG Summit and Changi Airport, among others in the consortium, will now be operating and maintaining the new passenger terminal. Very interestingly, however, LIPAD CEOs B. Yong Chun Gunko, I hope I'm saying that correctly, said that the old passenger terminal might now be converted into, get this, a vaccination hub. Meanwhile, you can see Megawide's share price down together with the rest of the index. That is down by 0.25%, trading at 7 pesos and 90 centavos. Okay, guys, checking in on the biggest headlines. We're keeping our eyes on PEZA. It's looking to bag at least 100 billion pesos in investment pledges this year. That is only slightly higher than the 95 billion pesos pledged last year. PEZA Director General Ching Plaza said they don't want to promise high figures, but vowed to work hard to build support and partnership from public and private stakeholders to bring in investors. Now, last year's pledges fell short of the agency's target to approve at least 100 billion pesos in investment pledges. That's a target already lowered to factor in the pandemic. PEZA traced the decline to various causes, including COVID lockdowns that started in mid-March. Now, moving forward, Plaza said they would conduct monthly fora where export investors, foreign chambers, and other foreign and local partners could meet to discuss business and investment opportunities in the PEZA ecozones. Now, the updated Philippine Development Plan has been approved by the NEDA. This is after the majority of board members signed the ad referendum on January 7th. The government began reviewing its economic goals and programs under the PDP 2017 to 2022 last year. That's as the pandemic drove the economy into its first recession in almost since 1998. Now, NEDA is set to release the updated plan on February 4th. This covers the government's priorities for the next 2 years. Acting Secretary of the NEDA, Carl Kendrick Chua, said the plan would include reforms and strategies to meet sustainable development and long-term growth by 2040. Under the original blueprint, the government had targeted to become an upper middle income economy by 2022 and achieve an annual 7 to 8% growth rate, as well as reduce the poverty rate to 14%, among others. The Philippines is strengthening its ties with Indonesia to boost both countries' copper industries. Now, the Trade Department said officials from the two nations met virtually last week to share good practices and explore investment opportunities, as well as areas for collaboration in that sector. Now, Trade Undersecretary and BOI Managing Head Seferino Rodolfo said Indonesia could help the Philippines boost its copper production, transport, and storage and marketing. BOI Executive Director Maria Corazon Halili Dichosa, meanwhile, said the two countries can work together to improve their integration in global value chains. The board said Indonesian officials welcomed future cooperation activities to help the downstream copper industries of both nations. The agency said the copper industry is one of its priority sectors for investment promotion because it is part of the country's recovery plan. Consumption is a key indicator of recovery, and today we look into the upstream supply chain trends. Here to share with us how their company has performed amid the pandemic, we have with us Alvin Lau. He's the CEO of D&L Industries. Good morning, sir, and welcome to the broadcast.
Good morning, Danie. Thanks for having me.
Sir, as any business, you have had a lot to deal with the past year, but tell us, how did you perform compared to expectations, compared to competitors, and what major changes occurred in the company?
So 2020 was a difficult year for us, just like, I guess, pretty much everyone else. Our business is split pretty much in half between food ingredients and non-food chemicals. The food ingredients business was understandably down because the food sector in the Philippines did suffer pretty badly. Everything from the lockdown to restrictions from people going out and a lot of the malls not being able to have a lot of people come in, plus the restrictions on dine-in as well. That had a very big impact, and that impact is still being felt up to now. The big impact, of course, also coming from hesitation of people to go out. There is still this big fear of people catching or getting infected from COVID, and that is still a lot of people are still quite afraid of getting COVID and going out. The non-food side has recovered much faster. It did dip
Okay.
in the second quarter during ECQ and MECQ, but we noticed in the third quarter, and this was disclosed, that our third quarter performance of the non-food side actually recovered to almost the same level as where it was in 2019. And so that is a good sign. It means that at least on some levels, the basic parts or the essential parts of the Philippine economy are uh, almost back to normal. And so we are taking that as a good sign. And so the outlook for 2021 is we are likely going to see recovery from 2020, mostly because it doesn't look like we're going to have the same kind of lockdown and restrictions this year compared to what we saw last year.
Okay, thank you, sir, for that update. Now let's talk about the figures more in depth. You mentioned the food part of your business having an expected contraction. Was that mainly because of lockdowns which affected manufacturing as well, or is that demand-driven softening? And your quarter and quarter in the third year seems to have recovered quite a double digit. Is that what you're expecting as well for the fourth quarter? And are you expecting this to be sustainable this year?
So we did see an impact on the supply side, particularly in supply chain, getting people to the plants to work on the plants and the manufacturing side. But that probably lasted mostly during ECQ and maybe the early part of MECQ. But after that, pretty much things did start to normalize. So I would say on the supply side, there is very little effect right now.
Okay.
The gap or drop in demand, I would say, is much more significant, and the effects of that drop are still being felt even now. So we are anticipating that this drop in demand will likely still persist for a while, especially since what I mentioned earlier, that fear of people of going out, they're not as willing to go out to eat and meet with friends and family and so forth. That is still going to have a big impact on the industry.
Will you be shifting your focus to other segments? As you mentioned, the non-food was, the best performer in this case, and you've also got others that are COVID related. For example, sanitation products that performed well. Will you be betting much more on this, or do you find that those are temporary surges in demand?
So the disinfectants, detergents, alcohol side of the business did extremely well. Part of it is consumers accumulating stock for use in the house during the pandemic. It is likely that once the pandemic is over, that demand will taper down, but likely not down to the same levels they were before the pandemic. So it looks like that interest and awareness on using better and safer detergents and chemicals and so forth, that interest will likely remain. And so what has happened is that education or awareness about what chemicals can be used, how to keep premises cleaner, not just in the house, but also in retail outlets, in manufacturing plants. That will likely, there will still be some demand from that side.
Okay, so it's actually a bright spot here that you can be focusing on, not just in the short term. And sir, finally, export market. You were targeting a 50% share on that. How is that doing, especially with global growth also having a dent here? Or is that still a better market to be focusing on rather than the domestic market?
So the advantage of exports is that the sales will be in a different currency from the peso. So it allows us to, in a way, hedge currency risk and be a little more flexible. What we saw in the pandemic was our exports increased from 20% of sales to approximately a third of sales of the company. So that was a big increase. Admittedly, part of that increase was because we were seeing lower sales on the domestic side. But nevertheless, it is something we anticipate will continue to do well. We do believe that a big or increased interest in our exports came from the interest in coconut-based chemicals, and we make a lot of these ingredients that are used in detergents, which are made overseas or sold overseas. We also make a product called medium chain triglycerides, or MCT, which is consumed by people, and that has also increased in popularity. There is an increased trend globally for higher awareness in safety, wellness, and health, and it looks like we are benefiting from that.
Okay, so very interesting change in trends here as, of course, DNL starts to pivot and focus as well on these products for the long term. Thank you so much for those insights. That was, of course, Alvin Lau, CEO of DNL Industries.
Thank you.
And that's a first look into the business day. Today is Monday, January 25th, 2021. Catch Business World Live for the market close. That's at 3:15 p.m. today. I'm Danie Laurel, and we are One News.